Gold ETF outflows are slowing. This is 3 days ago, signaling the correction is nearly complete. Deutsche Bank expects gold to stabilize above 3,900 as volatility normalizes. Meanwhile, China's new VAT rules on jewelry will have only a modest impact since gold demand remains inelastic and imports steady. The data suggests Western paper selling is easing while Eastern physical demand continues to absorb supply, reinforcing gold's underlying strength into year-end.
Welcome to the Morning Markets and Metals with Vince Lanci, where each morning Vince brings you the financial and precious metals news to get you ready for your day. And now, here's Vince.
Good morning, everyone. I'm Vince Lanci. This is the Goldfix Market Rundown. It's November 10th, 7:45 a.m., and we'll be talking about the top right-hand post there. Deutsche Bank gold correction likely over. China VAT unimportant. This is the second report they've put out to this effect, and it's turned out to be right. We shared the other one, or the breakdown of the other one, I should say, and this is a breakdown of that one today. It also includes their commentary about the China VAT tax. You can see we have a GIF, whatever you say it. Hartnett's Masterclass in Macro. Hartnett's report this weekend was very good in elaborating and describing or further drilling down on the risk to the AI market, bubble or not, and what would make it be a bubble breaking, as shown in that picture there. And the lower right-hand side, we'd like to draw your attention to that if you have the patience for a 2-hour lecture, seminar, community discussion. We uncovered, using the data from another founder, we uncovered what we think is how exactly banks that are short will cover when they cover aggressively and make it less transparent than it ought to be. And there's a statistical breakdown of that and a couple charts to that effect. Plus, there are plenty of other topics discussed on the metals markets and the macro markets in general. So let's get started. 10-year yields are up 4. The dollar is 99.57, up 1. The S&P 500 is 67.89, up 48. The NASDAQ is up 198. The VIX is down 54. Gold is up 94 at $4,094. Silver is up $1.74 at $50.05. And copper is $5 and spot bid, up almost 9 cents. WTI is up 19 cents. Natural gas is up 16 cents, 4%, above $4 now. We're getting into the winter stuff. Bitcoin up 1,100 at 105 and change. Ethereum up marginally at 35.91. Palladium up 32, up 2.3%. Platinum up 36. Gold, silver down, as you would think. Soybeans, corn, and wheat all up, with wheat leading the pack. Okay, so there's news out over the weekend that the government is getting closer to coming back online. The shutdown is potentially ending soon. And that would be, you would expect it to be bullish for stocks. You would expect it to be maybe a little bit bullish for the dollar. But you would not expect gold and silver and copper and oil and natural gas to all be up on that news. You'd expect Bitcoin to be up, but you would not expect gold to be up $94. And I think that's because the shutdown is not what gold cares about. China is back playing the game. Look, the ceasefire in October that coincided with the high in gold, that ceasefire is just basically a pause for everyone to reload their guns. This is a Cold War, and gold is one of the financial weapons of mass destruction if we're not careful. Anyway, we'll go into the charts on gold and silver as well, because I just identified the ledge. And frankly, it's very surprisingly good, the news. All right. The main story, the correction in gold prices is closer to its end than the beginning. About 2 weeks ago, Deutsche Bank put out a report saying that based on the ETF flows and the lack of follow through on the downside, they thought we were closer to the end than to the beginning. And a week later, they may be proving to be right based on activity today. Gold ETF outflows are slowing. This is 3 days ago, signaling the correction is nearly complete. Deutsche Bank expects gold to stabilize above 3,900 as volatility normalizes. Meanwhile, China's new VAT rules on jewelry will have only a modest impact since gold demand remains inelastic and imports steady. The data suggests Western paper selling is easing while Eastern physical demand continues to absorb supply, reinforcing gold's underlying strength into year end. Now, there's a behind the scenes commentary to make about this. And first of all, with regards to the ETF outflows, one of the charts they have in there, basically they're doing it in analog. The last time the ETFs puked this much, we're talking about Western ETFs puked this much, gold dropped this much. This time ETFs puked that much and gold dropped the same amount. And so they said this is probably the bottom because it's the ETFs that are selling. And there are other nuances that I think are very interesting. For example, on the big down day, down $230 or so, ETFs didn't puke. They puked 2 days later. And the drill down from that is I think the ETFs were puking. And I just think banks like JP Morgan were catching the falling knife as it fell because they need to buy the gold. With regards to the VAT, we had been talking about, now that's a corporate analysis. Basically, the VAT damages jewelry demand, and how much does it damage jewelry demand? And it's a very good analysis. But when this news came out, Bai and Eric were talking about it on X, and right away it made sense to me. And I just want to share that with you, and I'll talk more about this in a founders chat later on. But simply put, if you're not familiar, China removed an exemption for VAT, and that meant jewelry, I'm paraphrasing here, non-monetary gold would have a VAT tax domestically. And what it did is it kind of put the kibosh on the Shubai, I'm sorry, I'm saying the name wrong, Shubai jewelry market, which is a very big liquidity pool and where Chinese people go to buy their gold, like the Diamond District used to be in the US. Now, everybody was fretting and worrying about gold demand, and Eric and Bai were explaining it. And I put a bow on the whole thing, and it's since been picked up. If you just back up a little bit to one of the things that we've been saying for a couple of years, China is projecting its buying power outward. And in order to do that, it needs to do several things. Liberalize gold ownership, it did that. Encourage financialization of gold internally so they can use it as insurance products, they did that. Link savings accounts to gold purchasing accounts, they did that. And then liberalize it outside in the BRICS area. So vaults, convertibility into the renminbi, what have you. Now, and as all these things are happening, little by little, the market structure, the global market structure of gold changes. And when that happens, the pricing power of demand in China starts getting unleashed and it starts driving up the market. So, for example, there's a premium in Shanghai gold to US gold. Well, when that premium drops, that's because the demand is coming out. So the premium drops because the market is going up and chasing the premium higher. And so that's been happening. But this particular thing here is interesting for me as something that happened in my career. When they changed the VAT tax rules, all they were really doing is they were forcing the marketplace, right? That's what it is. It's really like a bourse, right? It's a marketplace to go to the exchange to get its gold. They were removing the arbitrage that the jewelry salespeople were using to exploit the differences. Now, this is what you do. Look, when you have a fragmented market or a market that's kind of like the Wild West, and you're trying to project price globally, you need to preserve the liquidity of that market, but restrict the shenanigans that go on in it. And they just had a couple of companies just blow up from naked short selling, and that's a risk when you're playing this whole jewelry rehypothecation thing or fabrication rehypothecation. Anyway, to sum it up, to put the bow on it again, essentially, if you're old enough to remember the trading floor, the jewelry exchange is a trading floor, literally, right? Okay, so the jewelry exchange is an important part of China's domestic gold demand. Everyone in China is buying gold, and many of them buy it from these exchanges. And so that's the trading pit. And the electronic exchange is CME Globex. And you have a lot of liquidity here, and you want to get it on there. You want all your demand to be aggregated on this platform, SGE, SHFE. And so you change the rules to keep the liquidity together, and you port it on the electronic platform, which is what the CME did when they listed gold electronically. They encouraged people in the pit, like myself, to make markets on the screen. Same idea. It's actually quite brilliant because you protect the demand. You don't let it just run all over the place, right? And then you take it and you say, okay, now I want you to do everything that you're doing, do it here. And once you consolidate your demand and you've pulled in all the supply, you just hit a button. I mean, metaphorically, you hit a button and you start projecting price out further. These things will be a consolidation of market share, a ring fence, I like to use that phrase, right? A ring fence of demand and protection of liquidity pool and getting ready to project price out further. Gold price is determined by China now. That's where the demand is. And gold price is controlled by the West now. It's an analogy that I use a lot with the founders. So essentially, China is projecting its price further outward. And keep in mind, they did this after the summit. You know, gold rallied headed into the summit and then sold off after the summit, and now it's rallying again. Anyway, enough with that. Let's go to the actual. I want to get to the chart, so I'll go through this quickly. Related posts, bank short covering shenanigans uncovered. Just mentioned that. Hardnet Masterclass. Gold will continue to outperform silver and platinum. That's an analytical firm makes the case that gold will continue to outperform silver because of its network, and the logic of that is Bitcoin eventually will outperform everything. 11th of November, that's the end of World War I, when the guns fell silent on the Western Front. WGC, central bank buyers are now price insensitive. We put that out over the weekend. In case you missed it, that's the previous day's posts. And coming soon, we're going to break down that report. Gold may still outperform silver going forward. We disagree with that, but you can't argue with the logic if you subscribe to how they look at things. Catherine Austin Fitz, who's like a former central banker who understands the market structure of things very well. We like her stuff. She did an interview describing stablecoins and quite adeptly at how they're going to, if we get our way, revolutionize and preserve the dollar. And a lot of people are talking about that now in our neck of the woods. But she gives the good side and the bad side. Eventually, stablecoins are CBDC, whether you like it or not. Just CBDC by a different name. And then special Bitcoin will be a G7 central bank reserve asset. That's not a bull call, okay, even though we are along it. That's a comment that because of things like stablecoins, the U.S. will do everything it can at some point to make Bitcoin worthy of being a central bank reserve asset, we think, on the G7 side. On China, not going to happen. All right, data on deck. The shutdown may be over, hopefully. So if it is, we're going to have CPI and PPI this week. There's nothing scheduled today. Veterans Day is on Tuesday. The bond market is closed, so we have some problems. There's some Fed speakers. Let's go to the charts. So here's gold, right? There's the daily, right? Now, this is the yellow lines. Those are the old, that's the old channel that I had. And I thought we had a new one forming, and we still do have a new one forming. And this was the ledge that I identified. Take out my drawing tools here. Does that work? Yeah, right. So this is the ledge we identified, right? We said if it breaks this ledge, it shouldn't go below here, right? And this is the area that reminds us of way back, the same idea before. And so we kind of drew this line. Once again, we're drawing a line saying this seems like a logical place to sell. And it just blew right through it. I got to tell you, I'm really surprised by this, that it hasn't stopped here. And my next line is here. Now, I'm going to revamp this a little bit because of the strength through this area here. This is where the real selling was. Why was it real? Because we stopped. That's why it was real. And this is the echo. I think that's the same person keeping a little in the market, making sure it stays a little bit tamped down, if you know my meaning. Now, the fact that we've gone through here and we're up 2.4% today, that's amazing. Makes me think that we're going to challenge here. Now, and I don't think it's going to hold this time. I don't feel strongly about that yet. I have to do a little bit more work. But we are still in a range, right? So here's the lower end of the channel. Maybe this is the range now. Maybe we're going to work in here. I don't know. But I will say this. Let me do some math here. 3,900 essentially, and 4,100, that's 240. All right, so if we settle above this spot right here today, I think you can add $200 to the price pretty quickly. So right up to 4,300, and then we determine what's going on in the market. So this would be a measured move potential. If it breaks this, if it breaks this, depth equals distance, and that gets us up here. So again, it's just a theory. It's something that has served well here, but it's too strong. I mean, I really think China is just basically giving the West the finger now and saying we're going to do whatever we want now that the negotiation is over. And they're kind of putting the screws to us. All right, let's go to silver, which is easier. Here was my similar range in silver. Again, broke through it, but we're at a higher level to begin with. So now we'll do a measured move here, 49 to, call it 49 to 46, $3.49. So as long as we stay above 49.30, give or take, let me readjust this a little bit to be a little bit safer here. As long as we're above 49.50, 53 shouldn't be a problem. Okay, knock on wood. And coming back to gold, I mean, it's almost, I was going to say, as long as we're above 40.30, which was my first range level, we should go to 41.50. Now I'm saying, well, this doesn't really matter that much. It's happened so quickly. If we get above 4,100 and settle there, then we'll probably pause at 41.50 on the way to 4,300. And then from there, you could see if these guys are here selling again. Anyway, up $104. I mean, come on. We're not in control anymore. Anyway, I'm Vince. Have a great day.
Well, thanks for watching this morning's Markets and Metals with Vince Lanci. We sure appreciate you tuning in and starting your day with us here. Hope you enjoyed the show, and we'll see you again tomorrow. Please note that this video is not intended as legal licensed financial trading advice and is to be used for informational purposes only. Please contact your financial advisor before making any decisions, and thanks for watching.